Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. It's a new week, but with seemingly old narratives. There is still a war going on. The hawkishness of Fed is still a cause of concern for the risk assets, and globally, we are still seeing concerns regarding inflation. Now, throw a company crisis into the mix, like Credit Suisse, which is a Swiss bank, which has been under a lot of stress after the CDS rose 15% last week, triggering a lot of concerns. Now, on the domestic front, on Friday, we had the RBI MPC decision. The central bank hiked rates by 50 basis, which was in line with market expectations. Morning, Pankaj. Being an ardent follower of the money markets, what are the highlights of the MPC statement and how are you seeing the markets this week?
Good morning, everyone. Thanks, Swaraj. It's a nice morning in Bombay, very sunny morning, and we are entering into Dasara week. RBI policy was, as per expectations, broadly by the market. We also expected there is a 50 basis repo rate hike. We expected 30 basis lower GDP growth, which RBI has trimmed down by 20 basis only. There was no change in inflation expectations, and these were all in broad market expectations. But the thing which RBI statements came on RBI FX reserves, they were very quite worried to understand what happened to our reserves. When we are thinking that RBI intervening aggressively, actually the fall in reserves was up to 67% during the year due to valuations like US Treasuries gone up, Euro and GBP fall, and that impacted FX reserves more than really RBI intervention. Yes, RBI intervened. RBI intervened in spot market, in a reserves market, and also in the forwards. And the forwards trim down was just significant. We further expect that there would be a rate hikes in coming months. I think next we will be announcing the numbers or we'll be thinking the numbers. But as of now, looks like that the next rate hike should be in the bracket of 35 basis, and that should take it to the sixth quarter in the next meeting. Indian 10-year GSEC yield closed at 739. It was more like a range bound, but there was a move in INR, and what we saw that a significant fall in dollar against INR from 81.69 to 81.15. Now this happened on a RBI's nudge to oil companies of using a credit lines of $9 billion. And that's basically gives us a breathing space to markets. If the global markets adjust during this time frame, we will have a slightly lesser impact on a dollar rupee. The Indian economy is doing really well, which is being shown by GST collections, which are up by 26% year on year at 1.47 lakh crores for the month of September. Basically Friday, Saturday, Sunday, all market financial market guys went on a tracking what happening on a Credit Suisse. There are many banks looks like having a tight liquidity position because of this sudden hike in interest rates. They will need time and some breathing space to mobilize those money. But the statement has been given by CEO of Credit Suisse that we are watching the conditions. Situation is at critical levels. We are changing our balance sheet structures, and let's see how it moves. 5-year CDS, which is currently dealing at 250 basis point, moved over 200 basis point during this calendar year itself, and that's put the financial market on slightly on a watch. Rating agencies Standard and Poor cut the outlook for its Bank of British sovereign debt from a AA credit rating. They are maintaining the rating, but they have changed the outlook from from stable to negative. As this judge Prime Minister Liz Truss tax cut plans and will have a debt to keep rising. The other side on a Eurozone is basically inflation keep moving higher only. They have hit 10% in September, a new record high that will reinforce another jumbo interest rate hike, which is likely to be a 75 basis point in October itself. Japanese Bank of Japan continue to spend their reserves. They have intervened closer to $20 billion in the last week to keep the yen under check, dollar yen under the check. Ministry of Finance shows that basically their real liquid, readily available intervention amount has drained by 15%. Now, what's happening globally? The important thing is in this risk of a sentiment environment, cash is king. Federal Reserve Facility, which is a major reserve liquidity facility, has got to basically highest number. $2.367 trillion have been parked with the Fed with the overnight reverse repurchase agreement facility. This facility pays 3.05%. This is a significant number, that $2.367 trillion, which is basically with the U.S. prime banks, and they are parking with the Fed. They are not utilizing this money. That kind of a risk aversion as of now being running through the system. Treasury yields have some reprieve after the Bank of England intervention. 10-year US yields are moving around 380. There is a marginal reduction of a probability of a 75 basis rate hike from 80% to 65% happened this morning. Now, market would be watching two critical data points, NFP and CPI, in the next 15 days to take a clue what Fed would be doing in the coming months. Euro and GBP bounced up on the month-end buying. Euro and GBP were up 2.5% and 9% respectively from their low levels, and currently dealing at 0.9803 and 1.1123. Gold has been range bound after a very strong rebound on a Bank of England yield buying program, and now dealing at a USD 1664 per ounce. What we are also checking up is Bitcoin is not able to scale back above $20,000 per unit in last 2 weeks, showing that tight monetary expectation hurting this digital asset. The oil prices started moving higher on expectations that OPEC would be cutting their output by closer to 1 million barrel, and that's expectation is moved basically a crude oil on a higher side. That's all from us this morning. Thanks a lot for listening to us.
Thank you, Pankaj. That was crisp. As Pankaj mentioned, for the RBI MPC policy, we of course had no change in inflation expectations, and we saw a fall in FX reserves. But as Pankaj mentioned, it was to a large extent due to revaluations, considering the fall in Euro and GBP. Of course, RBI did nudge its oil companies to use credit lines. This would reduce some pressure on the spot buying. Now, of course, we discussed the Credit Suisse and its tight liquidity position, but it seems Twitter was having a lot of fun with a lot of memes floating around during the weekend. So if you want to have a laugh during this not so bright financial outlook, you can definitely check out the Twitter space for Credit Suisse memes. That's it for today, folks. Keep listening to this space to get your latest updates on the financial markets. We'll see you all tomorrow. Have a good day.